All right, for more on what is in store for the U.S. economy, CCTV's Rachelle Akuffo spoke with Max Wolff. He's the chief economist at Manhattan Venture Partners. And Rachelle began by asking him what grade the U.S. economy would get for this year's performance.
This is a solid B-plus year for the U.S. economy, so certainly more than good enough performance to stay out of any kind of trouble or long-term difficulty, but certainly nothing stellar and the sort of tremblings of some future problems to come. So this is definitely a student that you'd want to double down on the fundamentals over the winter break here before the spring semester.
Now, I know you mentioned problems to come, but some economists actually expect 2016 to be even better than 2015. So would you agree with that?
Yeah, so I definitely wouldn't. I know there's a lot of folks who think so, and certainly depends on where you are in the world or exactly what area we're talking about. Lots of divergence of experience, in a world of nearly 7 billion people and 200 countries, et cetera. That being said, I think for the U.S., it's pretty hard to imagine that 2016 doesn't see a little bit of a reset because we are very deep into a long run that looks like it sort of ran on fumes and excitement and maybe a lack of better ideas for the second half of 2015, which generally means a slightly tougher slog in 2016.
So talking about some of those concerns, what do you think, if you had to name 2 or 3 of the perhaps biggest concerns you're looking at for next year, what would they be?
So for me, the sort of wealth cycle has turned. I think it actually turned in July or August for the U.S. economy. In other words, this positive wealth effect we've had from a real explosion upward in asset prices. True if we're talking about residential real estate, true if we're talking about private shares and private deal valuations, certainly true if we're talking about public shares and public valuations in the stock market. We've seen a sort of meteoric rebound and then a kind of off to the races scenario here, really for 6 years since 2009. That's unusually long. We ran really far, and we're going to have some comeuppance here. We're going to have higher interest rates. We're going to have a lower risk tolerance by investors around the world. I think we're going to see the U.S. equity markets in for a very tough first couple months in 2016.
Federal Reserve policy, there was a lot of will they, won't they all throughout 2015. How do you think that's going to shape the economy in 2016?
The Fed is raising interest rates, in my opinion, for 2 reasons. One, so they can cut them if we have economic trouble, which I think we will at some point in the pretty near future. And 2, because they're under enormous political pressure. Ironically, both of those are bad macro reasons to raise interest rates. There really doesn't seem to be much of any inflationary threat. Gas prices are way down, home heating oil prices are down, food prices are down, commodity prices are down. There's very little wage growth, and there's mediocre 2 and 2.5% economic growth. So there's none of this traditional things that would make us raise rates, but we're gonna, and now the U.S. is gonna raise rates while much of the world, Europe, China, et cetera, may very well be cutting rates. So we're gonna have this disjointed global monetary policy being done by the U.S. for reasons that don't really jive with the fundamental reasons usually do that. And what I think that means is we're going to have a weaker period in the U.S., and I think that this idea of American growth exceptionalism is sort of nice. We had a bit of a run with it, and I don't think it's going to last the entire duration of 2016.
And you also mentioned the political pressure. Now, 2016, obviously, we have the presidential elections coming up. How do you think that's going to impact the economy?
So I think, unfortunately, it already has impacted the economy. I think it makes us weaker. And I'll give you 2 reasons. One, the Federal Reserve in the U.S. has been deeply politicized. So it means it's under enormous political pressure by people who are making policy suggestions, very aggressive suggestions to the Federal Reserve, based on their ideological commitments, not based on data or recent economic history. When ideologues make monetary policy, the end result is usually not great. So that's a problem. And the other thing is, for the first time since 1932, if we have a downturn in the United States, we probably won't do any fiscal policy, because that would require the White House, whoever's in it after next year, and Congress, and we sort of have an idea of a dysfunctional Congress that'll probably be with us for a while. They're going to have to get together and make fiscal policy. Politically, that's almost certain to fail, so we're not going to get it, and we're going to have almost no leeway for monetary policy. So I don't think the economy is in terrible shape, but I think there's a non-trivial risk of a recession, and for the first time since the Great Depression, not the best benchmark last case, we don't really have the standard economic policy measures in place to respond to weakness should we encounter it, like, say, much of the rest of the world is already in the process of encountering.
Now, also, one of the things that the rest of the world, especially emerging markets, are going to be looking at is the strength of the US dollar. It's been strong for 2015. Do you see that slowing down perhaps next year?
I think that at least the first half of next year, the U.S. dollar will continue to be quite strong. The reasons being we're going to continue to see some pressure on the commodity space, and we're going to continue to see an unusually disjointed global monetary policy regime. One of the things, by the way, it does mean, which not everyone seems to be factoring, is a little more headwind for U.S. exporters and a little bit easier time for U.S. importers. So the only thing that's making this look better, I think, than it otherwise would is the whole world, U.S. included, has a little bit of a windfall check here because the basic things they're buying in the commodity form, they got a bit of a refund on because the prices fell so much.